For many years, proxy advisory services have been provided by a duopoly comprising two companies, Glass Lewis and Institutional Shareholder Services, with a combined market share of 97% engendered by blatant political favoritism. Proxy advice means recommendations to investors, retirement funds, and large asset managers holding major stakes in public companies on how to vote on shareholder motions and other such proposals. Because of deeply perverse recent rulemaking, both formal and informal, at the Securities and Exchange Commission, the proxy advisory process has been transformed into one in which large institutional shareholders in a given company are virtually required to accept the recommendations of the proxy advisors. In particular, an important SEC rule, Rule 14A8, has been changed to require firms to consider resolutions of wider societal interest. The upshot of this system, utterly without statutory authority, this proxy advisory duopoly has become a de facto regulator of public companies. The proxy advisors can make recommendations that do not affect their own financial interests. Accordingly, they have indulged their political preferences with little concern for the interests of retirees and shareholders. The result has been a wave of proxy proposals promoting environmental, social, and governance objectives, the central examples of which are various greenhouse gas and climate proposals, discrimination against fossil fuel investments, the pursuit of racial and gender quotas for corporate boards, and other such pursuits of political objectives with other people's money. The blowback against this expansion of the ESG game has become formidable, an outcome unsurprising precisely because ESG represents a fundamental threat to the financial interests of large numbers of investors, retirees, and firms. Because retirement funds and institutional investors have fiduciary responsibilities to their clients, litigation has loomed large as a threat to the pursuit of ESG objectives, and various states have threatened litigation and disinvestment over such efforts to dilute the fiduciary responsibilities of pension funds and to discriminate against important local industries. The three largest asset managers, BlackRock, State Street, and Vanguard, already have retreated from their previous enthusiasm for ESG investing. In its 2023 annual stewardship report, BlackRock reported that it had supported only 7% of environmental and social resolutions, down from 22% in the previous cycle. Similarly, a 2022 report from Sherry Action, reviewing the world's largest asset managers' voting records on ESG, shows that Vanguard and State Street supported only 10 and 29% of ESG shareholder resolutions, respectively. In 2023, support dropped even lower. In a major new development, BlackRock has announced that it is adding Egan-Jones as a third proxy advisor option, expanding its voting choice initiative by adding two new Egan-Jones proxy policies, one of which does not prioritize environmental or social goals. Ignore the soothing BlackRock blather about its commitment to providing our clients with choices to support their growing range of investment preferences. This BlackRock addition of Egan-Jones as a third proxy advisor with an emphasis on economic returns rather than ESG objectives is a frontal assault on the duopoly described above and its preferences for politicized voting on proxy proposals. Ignore also the forthcoming assertions from those pursuing their own political interests with other people's money that ESG objectives are important for public companies and retirement funds and are great for returns in any event. Artificial constraints on investment options that vest from fossil fuels cannot improve investment returns to a portfolio over the longer term and are inconsistent with the diversification needed to maximize expected returns for given levels of risk.